All right.
You're on, Linda.
Welcome, everyone, to the second installment of Endeavor Presents, Leading Through Crisis. I'm Linda Rottenberg, the co-founder and CEO of Endeavor, and I'm here with my colleague, Alan Taylor, who is the co-managing director of Endeavor Catalyst. Hello, Alan.
Morning, everyone, or evening, wherever you are in the world.
And we are thrilled to be joined today by an incredible panel of some of the best investors who are also great founders and scalers of top entrepreneurial firms. So please welcome Martin Escobari, Nico Szekasy, and Shailesh Rao. Welcome, men.
Hi, thank you.
So it's great to have you. And I was really excited to have Endeavor entrepreneurs around the world hear from you because obviously issues of accessing capital, issues of leading through crisis and dealing with some of the tough choices is on everyone's mind. And what I love about the three of you is that, as I mentioned, you're not just some of the world's best investors, but you also have operational experience. And so you know what it feels like to make the tough choices firsthand. So I wanted to start by having each of you share a bit of your stories, your backgrounds, and include how you came to know Endeavor. So Martin, why don't we start with you?
Sure. Let me tell you about a near-death experience as an entrepreneur, and then emerging from that, how I met Endeavor. So we were, a group of us were co-founders of the #1 e-commerce company in Brazil called Submarino. It's the Amazon copycat in 1999. And we were doing so well. We had raised $200 million. We had opened in 5 different countries across Latin America. We had filed for an IPO in NASDAQ. It was April of 2000. We were kings of the world. And then NASDAQ crashed. And what looked like a brilliant strategy, which was to grow at all costs and prepare for an IPO, was a dismal strategy because we were burning about $10 million a month and we had about 2 months left of cash, 3 months left of cash. And no one wanted to touch us. We went from being kings of the hill to pariahs. And our #1 competitor, which was a brick and mortar retailer, made a lowball offer to buy us for $25 million. So we went from $500 million valuation prospectively to $25 million bid, and we accepted it because we were desperate. We were running out of cash. We didn't know how to cut our way to profitability. And in due diligence, they concluded that it was better to let us die than to pay $25 million to acquire us, which I am grateful to this day that they did. So they walked away and we had to fight to survive. And we cut costs into survival. We turned a small profit, eventually went public in 2004. And in 2006, that same company that tried to buy us for 25 million paid 1.6 billion. So we went from 500 to 25 to 1.6, all within 3 years. But that was a near-death experience. And emerging from that, after we sold the company, I became very, very active in Endeavor. I've been an Endeavor mentor for almost 15 years. And it's one of the most gratifying experiences. And I've met hundreds and hundreds of entrepreneurs. And because we only get very little time with them, I try to be very provocative, bold, and aggressive. And it is so rewarding 10 years later when people still are upset with me, but tell me that I might have contributed to something that they did differently in the following 10 years.
Tough love. And can you just share for those who don't know you, since we have entrepreneurs from all over the world dialing in, what your day job is?
So right now I'm co-president of General Atlantic. General Atlantic is a private equity growth capital firm. We manage today about $35 billion and we're global. And I also chair the Global Investment Committee.
Great. Shailesh, why don't you go next?
Great, thanks, Linda. Thanks for having me. My name is Shailesh Rao. Spent about close to 2 decades now in technology, mostly an operator, and lived through the tech bubble, as we were just hearing from Martin. Had my own experience, which we'll come to at some point. The highs and lows, the euphoria, and then the kind of grinding it out realities of trying to survive day to day. That's when I was running product for a fintech company in the early 2000s, and then spent a long time at Google and was at Google when we had to kind of also make it through the great financial crisis. And many may think that Google is impervious to these things, as we're seeing here in the pandemic. Large companies are also not impervious. When there's a crisis, everyone shares in it and has their own sort of challenges to deal with. And then spent about 4 or 5 years at Twitter, running our international business and helping the business expand. So I see what's going on now, and trying to think back to a lot of those memories that I tried to forget, but lessons that I think would be useful now. And I spent the last couple of years both as a senior advisor, as a partner at TPG, in the Growth Fund and the Social Impact Fund, covering much of Asia, India, and Southeast Asia. And that's how Linda and I got connected when they had an interest in expanding Endeavor's coverage, Southeast Asia and India. I've been trying to help. I'm fairly recent to the Endeavor relationship, but I got to know Linda maybe a year ago, a little less than a year ago, and we've been active conversations, she and the team and I, about how I could be helpful. And most of my career has been marked by a belief that entrepreneurship can take root and succeed anywhere in the world, which is why I've spent the last more than a decade overseas, even though I grew up in the U.S. And when I saw Endeavor's mission and talked to Linda, it just felt a real alignment with providing the resources, the network, the support to help entrepreneurs around the world, flourish, succeed, and scale. So excited to join you today.
Great to have you. And you helped launch Google Maps around the world. So there's notion of hotspots popping up. Really, you guys were at the forefront of that. Now we're talking about it daily. It must be a little surreal.
It's amazing how it comes up all the time in odd ways, because it's a daily utility and everyone has their own experience or their interaction with that kind of service. So it's gratifying, but I get a lot of questions at cocktail parties, that's for sure.
And last but certainly not least, Nico Szekasy. Oops, you're muted.
Nico, you're on mute.
Eventually, all of us will figure out this Zoom unmute thing.
Am I fine now?
You're good, yeah.
Yeah. So I'm Nico Szekasy. I have several Endeavor hats. I'm an Endeavor entrepreneur and a board member in both my home country, Argentina, and global. I have been involved now, I guess, 20 years, since the days that crazy Linda, la chica loca, was flying all over Latin America, trying to explain to the locals like myself the meaning of this weird word called entrepreneurship. I think we learned it since then. It's been an amazing ride since those days. Endeavor has been a key engine on building the thriving ecosystem here in LATAM. And more on the personal story, I was part of the founding team at Mercado Libre for a decade, between 2000 and 2010. Mercado Libre, or MELI, as we like to call it, that's the ticker symbol, is the leading e-commerce and payments platform in Latin America. We took it public on NASDAQ in 2008. Has a market cap, you have to check it.
Wasn't it one of the last companies to go public in 2008?
So it was crazy. Yeah, we went public like a few months before Lehman. So I have a lot of near-death stories from the 2000 days, from the 2008 dates. Happy to share those later in the conversation, but definitely one of the last companies, and we were on our roadshow and every day was crazy. It was like now, the Dow, the S&P up 5%, down 5%, very, very volatile. So crazy times, but we managed to get through the window at the very end of the window. And now it's interesting because I was trying to find what was the valuation, to quote it here in the call, the MELI valuation. I think it's around $30 billion today, but very different from 2 weeks ago, and it's going to be very different a couple of weeks from now. So that's one phase of my...
Yeah, $1 billion here or there, give or take.
It is how it goes. So that was the entrepreneur stage. And then in 2011, I decided that I was ready for new challenges. And the obvious choice was to become an investor and try to help the next generation of founders build great companies. So with my MELI partner, Anand Kaszek, who is also an Endeavor entrepreneur, we started Kaszek Ventures. It was really a painful decision because we loved MELI. We still love MELI. We have great friends there. We see them all the time. socially, and we're very proud of what they have accomplished and their continued success, but we both felt that it was the time to move on and do something different. And briefly on Kaszek, we raised our first fund in 2011, $100 million. Since then, raised 4 more funds. We raised more than $1 billion in total. We became by far the largest early stage. I have to say early stage because Martin is in the call. Early
And
stage
Shailesh.
VC, early stage VC in Latin America. If they were not in the call, I would just say VC, but here, out of respect, I'm putting the early stage part there. And we currently have more than 50 active companies in the portfolio. Interesting data point, and Alan can correct me if this is outdated, but I think we are the fund in the world with the more co-investments with Catalyst. And our strategy with Kaszek
GA's catching up.
Yeah.
You have some competitors, Nico, but you're still up there on that list.
I'm coming after you, Nico. I'm coming after you.
Alan is saying that because he wants to, he needs to run his business and keep everybody happy. So strategy is very straightforward. We're very, very, very founder-driven, founder-focused. We invest early, Series Seed, A, B, and we love teams that have an amazing vision, but we also love people that roll up their sleeves and execute and can get shit done. And we think that it is the combination of both things that result in building amazing, iconic companies.
Great. Okay, so here's how this is going to work. I'm going to start out with a few questions for the first segment. Then Alan will shift to the more Endeavor Catalyst and financing related questions for the second segment. But I want to encourage all the entrepreneurs online to use the chat function to ask your questions, because in the third segment, I'll be asking all of your questions to this great panel. We have my teammates, Marina and Kirk and Jimena, figuring it out and putting your questions onto the chat room. So please feel free to ask what's on your mind. So one of the things that came up last week with Reid Hoffman when we spoke to him was the issue of entrepreneurs having to make these difficult decisions, often involving team cuts of some sort. And the question became, how do you not impact your culture, and more pointedly, how do you take that remaining team and get them ready, as one of our Spanish entrepreneurs, Alejandro Tarcho, said, you know, how do you get them ready to be warriors for that next fight and not feel demoralized? So who wants to start with that question? Martin, did you want to start?
Sure. I mean, Nico and I have gone through this actually in a company. Younger managers who have never fired large groups of people have extreme discomfort of what the day after would look like after you do that, and find ways to try to delay that painful moment, and that's very costly for the probability of success as a firm. The most important thing is to be brutally honest, transparent, and talk to your employees as adults. People understand how serious this is. We all read the news. And you may not have certainties. The book answers, you cut once and all the survivors rally together and you tell them you're the chosen few that are remaining and we charge towards the top of the mountain. You can't even tell them that today because most companies have cut for one level of recession, which is the base case, but it might get worse and you may need to do a second layer of cuts. My advice is tell them that, but at the same time, celebrate the victories. There are victories in this resistance, in this fight against this evil virus, and over communicate, be truthful, be transparent, and celebrate the small wins.
I'd also add, having been through this post-tech bubble, unfortunately, at a fintech startup where I ran product, it was a precursor to Plaid, company called Yodlee. It was a Sequoia Excel Warburg company way back when. We had, a high-flying company, had to do a bunch of layoffs, and as Martin said, a couple of rounds, unfortunately. I think communication is critical. It takes on even more importance. Literally talking to employees every day, even if you feel like there's nothing to say, just the availability is key. And in that communication, most startups are mission driven and they're purpose led. And reconnecting back to the mission, back to the purpose, is a reminder to the team of why they're there. And knowing that that North Star is not something that was ever going to be achieved overnight anyway. And it's everyone's opportunity to recommit in the most difficult of circumstances. And it's a great forcing function to really have everyone say, you know, am I in this? Am I committed for the long term? And in a weird way, that reaffirmation binds people, you know, in a stronger fashion. Second thing is, it has to be meritocratic, has to be fair. It sounds obvious, but people are always watching when you make decisions. Do they make sense to you? Are they fair? Whether it's a promotion, whether it's a salary increase, or unfortunately, whether it's a layoff. And so if you tell a certain story about what you're doing, I'm getting rid of a line of business, or I'm shrinking a certain team for a certain justifiable reason, the people that unfortunately have to leave, that has to make sense. It all has to tie together. And there has to be a clear sense of merit. You know, the best remain and those who are not as high performers don't. Because once you start, you know, diluting the sense of fairness or merit in these times or moments, that's also another way to lose people, because they start not believing about the mission. That reaffirmation process gets diluted or potentially ruined. So those two things I'd say are really important is communication and re-anchoring to the mission, and making sure that the cuts that you make, if you have to make them, are sound and merit driven and data driven.
That's great. And Nico, I know you want to add something, but before you do, can you also address kind of the elephant in the room, which is you guys are operators, but I've been on boards, we've all been on boards, when there are some financially driven people who have never hired and fired people, and they just seem to want to cut at all costs and not understand. I mean, what you guys are talking about is very nuanced, it's very thoughtful, it's not arbitrary, but how do you also deal with board members and funders who maybe don't have the operating experience and don't quite get it? So I'd love you to wrap that into your comments.
Yeah, no, I can start with that. And I think that there are some entrepreneurs all entrepreneurs are optimists by nature. And sometimes you get financially driven investors that are pessimists and they see the glass half empty. And it's neither nor. You have to be a realist in this type of context. So I think there's always an equilibrium. And of course, it's case by case. I said that we have 50 plus companies in our portfolio. So every company has a story of its own. And what you need to do in every company is completely different. And in some cases, you need to cut very hard because that is the reality of that situation. In other companies, you don't have to cut anything. So you have to go case by case, but it's important to go first with this perspective that these are very unusual times. These are really hard times. And you need to, if you are a founder, a leader, you need to be very open to take the hard decisions. On the prior question on culture, I echo everything that was said. I don't want to repeat the same concepts there. Maybe I can illustrate with an example. In Mercado Libre in 2000, those are the times that Martin was referring to in his intro. It was the nuclear winter. And we were fortunate that we had raised capital before the bubble burst. So we had some cash in the bank, but we really didn't have a business model and we had way too much burn. So we decided that we had to improve our prospects and increase our runway. So we had to make cuts. We had offices throughout a number of countries where we had maybe 30 people per office. And we said, this doesn't make sense in this new world. And we went there ourselves and we cut maybe 90% of the staff in an office in Mexico or Colombia. We went from 30 people to 3 people. We had offices in the US, in Spain. We shut them down. We said that this doesn't make any sense. We need to focus in Latin America. So maybe overall we had, I don't remember the exact numbers, but maybe we had 200 people in the company and we ended up with 100 after that exercise. So we cut by half. It was brutal. And it's easy to tell the story now. It looks like a like a planned thing, but it was not like that. It was chaotic, it was sad, it was painful, but it had to get done. And then you fast forward to today, Mercado has 10,000 employees or more than 10,000 employees. So sometimes you need to take the tactical, tough choices because it is what is required in 2000 to be where you want to be in 2010. And now you need to do what you have to do in 2020 to be where you want to be in 2030. And I totally agree with Shailesh about the mission and the purpose. That is the North Star. You need to be focused on where do I want to be in 10 years and do what you have to do now.
Well, before I get to a question, we already have some questions from entrepreneurs, but you mentioned optimists and pessimists. I've been telling everyone my world, apart from my girls and all that we can talk about suddenly becoming homeschooling parents, et cetera, you know, my world has been broken up. I've called it a tale of two cities. Every time I'm on the phone with Endeavor entrepreneurs, they are charging forward. They're figuring out how to get more businesses online and increase the bottom line. They're also saying we have robotics companies in Italy and Jordan shifting production to try to help with ventilators, and we have other companies shifting to create masks, and they're charging forward on the front lines and thinking ahead. Then I get on the phone with the investors, and they're like, "Wait a minute, there are costs? No, cut them. There are employees? No, cut them." And you're like, ah! So it really is a different mentality. But moving forward, we have a question from Alfonso Iglesias of Auto Traffic in Mexico, talking about preparing for the future and taking any lessons now in order to, change their economic models, looking ahead to the next crisis. And I'd love to layer that in, and we'll start with you, Shailesh, on this one. But also, you guys have a lot of pattern recognition, and it would be really interesting for you guys to think, what are the worst mistakes you've seen people, make that also just really don't set them up for the future?
Yeah, I think, indiscriminate cuts or cuts, we talked a little bit about cutting, and I think I was going to make the point, so it's a great question. There is not a straight line between a crisis like this one or any crisis like this and sort of cutting. That's not the way the process goes, right? The process is, I'm running a business, I have a disruption to the business as a crisis. How do I rethink the business and redo my plan? Just to make it very tactical, most businesses will have a plan, a 12-month plan. That plan often, in terms of resource allocation, is some kind of balancing act between the short term, the medium term, and the long term. And what happens in crises is everything becomes short term, appropriately so, right? So when you do that, and you kind of recast your plan, and you make a series of decisions and changes based on that planning, and you communicate those changes on a regular basis, because of course there's so much volatility, every day is different, then you can make it through the business. People can look and frame that period of time, whether it's 12 or 18 months, as a crisis that was managed in a particular way, and then you slowly get back to let's say steady state business where you recalibrate again. The biggest mistake people can make is think that action is equal to progress and start to come off as chaotic, frenetic, and sort of doing things that are not thoughtful. There's a sense that, like a boat sinking, I have to throw life rafts and everyone has to jump out. There may be a time, there is certainly a time urgency, but it's not quite like that. You have to be thoughtful. You cannot check your brain out and say, I'm just going to do a bunch of stuff and be reactionary. Symbolically, the projection of that desperation and that anxiety is not healthy for the company. Substantively, if you make decisions that are not good for the business long term, it's hard to recover. It's hard to get those people back, or it's hard to restart a product that atrophies, or you shelve maybe unnecessarily. So I think being thoughtful, sticking to the process of planning, but doing it, acknowledging the changes in the environment, is a thing that shouldn't be lost at the door because people are freaking out.
Okay, Martin or Nico, anything to add?
What I would just say is I really think there's a big difference between the short term and the medium long term. Short term, I just want to make clear, and I think it has been quite explicit, but it is about ensuring that your company survives, and you need to be a realist. But there will be so many opportunities when this ends. Are we going to go in the same way that we were going before to to a shopping mall? Are we going to go to concerts? Are we going to get on a plane on a weekly basis? Are we going to go to the doctor physically to a doctor whenever something minor is hurting, or will there be other things out there? So we see a world that maybe, and again, we don't know the nature of this crisis, or is it going to be a V recovery or a U recovery or a W recovery? So nobody has a clue if this is a nightmare of 6 months or 12 months or maybe even longer. But at the end of this, there's so much opportunity for entrepreneurs. If you're an incumbent in a large industry, if you're a large retailer, you're in a tough spot. The world will be different. And if you're an entrepreneur, that you're fast and dynamic and smart and you get things done, there will be plenty of opportunities. So I think that's why we encourage every company in our portfolio and every entrepreneur that we talk to, make sure that you get to the other side of the storm, because it will be very sunny on the other end.
Martin, do you have anything to add?
Sure. We all rely on pattern recognition. Unfortunately, in this crisis, that can be dangerous. This is a crisis like none we have seen in the West for 100 years. Most of the crises we ever experienced has to do with the business cycle, over leverage, over valuation, then we go through the nuclear winter, but it's an economic winter. It's not a healthcare winter. The range of possible scenarios is wider, as Nico was alluding to. So this belief that these two shall pass and sun is around the corner may be slightly different this time. So I think given that the scenario fan is wider, the two mistakes, I think, one I have seen already been made, the second one I think I will see. One is not cutting deep enough to ensure survival through a more prolonged crisis. So you should make sure that you can survive 18 months of the economy being in a coma. That is the insurance you need.
Wow,
you
18.
Raise
Wow.
them. It may not lead to that, but there is a 10% probability that it is that. Why would you take 10% risk on survival? So not being bold enough on the cuts and the fundraising to ensure survival, I think, is one mistake. The other mistake is going on offense too soon. All our entrepreneurs are successful because they ignored risks. If they were good risk managers, they would never choose to do something that has a 90% chance of failure, which is to be an entrepreneur. So we love them for that. But in this particular situation, maybe you hold off a little bit, because I think you want to be able to see a little longer through the fog, and you're probably going to see the best opportunities not in the beginning of the war, but more in the middle or the late stage of the war. Those are the two mistakes I would focus on.
Just to
Okay, so I wanna-
emphasize,
Go ahead.
I'm just going to emphasize, because I agree 100%, Martin. We're advising, and the entrepreneurs I'm talking to, we are talking about ensure you have runway for 18 months.
Wow, but I will let Alan take the next question, but I just have one follow-up, just to push a little bit, because we have a number of questions coming from, Alejandro in Spain and George Polikaris in Greece, talking about the shift between people who raised capital. It was all about growth. Now it's all about cash preservation, right? But again, to refer back to last week's session with Reed, he talked about part of being an entrepreneur, you do maybe have a different risk assessment. Mortality is always, a possibility, right? He always talks about entrepreneurship, Reed does, as, jumping off the airplane and assembling the parachute on the way down, right? So how do you handle that? Like, when is too deep a cut? When is being too cautious? When do we as investors and supporters back the entrepreneurs because they have a different time horizon and a different risk assessment? And if we squelch that, we actually miss the opportunities on the other side. So how do you make sure we don't all become too conservative? So does anyone want to address that before we move into Alan's?
I can say this. I have never seen a team regretting for cutting too much in a crisis like this one that happens every decade. So this is a very unique time. This is not last year or 3 years ago or 2 years from now. This is right here, right now. I have never seen a team that regretted cutting too much in 2000 or in 2008. And I have seen a lot of companies that they played the optimist hat, and those companies are not there anymore. They have disappeared. They have gone bankrupt. So you need to buy, Martin used the word insurance, you need to buy some insurance. This is a very, very harsh few quarters. Have patience, preserve your life, and there's gonna be great things to be done in 2021 and onwards, but be patient and get there.
Okay, I'm
Yeah,
gonna
and
move oh, sorry, go ahead.
So just quick comment. I mean, yeah, I don't think it's about being too conservative. I think it's actually about preserving optionality to be a real entrepreneur, right? So raising 18 months of runway is actually about building the business, going forward, thinking longer term. I don't see that as being too conservative. Of course, you take a dilution hit, that isn't great, and you have to manage the process to minimize that as best as you can, but it is all about preserving optionality.
What's interesting, 15 years ago, I did a project with a Harvard professor and wrote a book around companies that survived the 1989 crisis in Brazil. And what we saw on the survivor companies, on average, they cut 50% of payroll. 50. And what I'm seeing across my portfolio, people are like very bold when they cut 15 and they feel awful. And what we learned in that group, and it's more true today, your ability to snap back to growth, rehire, is so quick in today's age, much quicker than before. So I think, yes, it's painful, but I think your ability to spring back is massive. Now, today we have flexibilities we didn't have before, which is sometimes you don't need to cut. You can renegotiate the terms of employment. You can tell your sales force, we're going to 10% fixed if you want to stay in this boat, but you have to agree to that. And come with me and we'll ride the way up if you don't want to do the deeper cut. You can variabilize costs more as a way of not cutting payroll. But I think to think that 10% cut is appropriate for this crisis might be too conservative.
Well, I've been saying that everyone felt the need to add all these perks, and I was saying now the job is the perk. Yeah. New world. But before I turn it to Alan, I guess for all the entrepreneurs out there like me who are saying, oh God, I think I have a lot of qualities. Patience is not one of them. I think we all have to channel our inner patience. That's why mindfulness, I guess, is more important. Okay, Alan, over to you, because I know there's a lot of questions about raising capital and financing in this new world.
Yeah, well, we definitely do have a lot of questions there, and I'll continue on a few of the same themes around kind of working with portfolio companies, really on, you know, I feel like the concept, the word of the day is runway, right? Everybody's talking about runway and how to get it and how to extend it. So before we shift to some of the more general financing questions, Nico, I wanted to start with you because I think it was over a month ago, you guys put out, I thought, a very helpful kind of note to your portfolio, kind of a top 10 list of things to do. And the first one said runway, runway, runway. Can you share for entrepreneurs who've joined us today who maybe aren't lucky enough to have Kaszek or GA or TPG on their board, what are some of the things you're actually working with your portfolio on to extend runway, right? Not just cutting team, but what are some of the other things you're focused on?
There's so many things in the answer. The first one, you can be, maybe you were lucky because you raised capital and you close your round in February, or maybe some other company which is similar in quality and in potential and was going to go to the market in March, and now it's a tougher environment. Mm-hmm. So there's always a certain element of luck or randomness in how something like this catches you. But having said that, there are some things that you can do internally to try to match as much as you can your costs to your revenues. There are very different cases. There are some companies, maybe in the hospitality space, that have seen their revenues go down to zero or to close to zero. So that's one scenario. We have some other businesses in some digital industries that they see their revenues, even in this crisis, growing by 2x or 3x. So they are beneficiaries of, in the short term, of the crisis. But I would say most companies are somewhere in between, and they see revenues declining by 20%, 30%, 40%. And therefore, you really need to see as hard as you can at your cost structure and go through the menu and see what are the things that are not indispensable anymore. I think marketing is a discretionary spending. You're not having to lay off people. in this type of environment, it's a pretty easy thing to reduce quite drastically, because this is not the right type of market for being aggressive there. Probably it's better for you to reserve those funds for later on. And then on team, maybe you opened an office in a new city and you hire 10 people and you're not going to be doing anything in that city. So it's quite evident that you don't need that group of colleagues. In some other cases, you can variabilize. So there's lots of things that you have to try to do internally, look into your suppliers, contracts, rent, and technology and others. And then you have to look at your balance sheet, at your cash situation, and anything that you can do. If you're short on Runway, to strengthen it, you should. So if you have line of credits that you can draw on and have them there, because there's going to be sun at the end of the storm and you need to get through that. So you need bridges to get there. If you are going to go to the market and maybe it's not a great time, but you have very supportive investors, maybe you can get an internal bridge to get you to the end of the year. So there are a number of things that you can do. And of course, if you have opened conversations before and you have a great business model and you have had in the past interest from investors, it's not that the world has stopped and is paralyzed. Ourselves, Kaszek, we are having meetings every week with new companies, and we are entertaining conversations, and we are closing transactions. So we are doing business, and we see this as a great opportunity to continue to invest, and many funds are doing the same. So it's a combination, it's a menu, many things.
Yeah. Well, we'll come back actually to that point of if the world is open for business in terms of new financings. But Martin or Shailesh, did you want to add anything? Recognizing every company is different, are there themes you see across conversations with portfolio companies or with entrepreneurs where they can extend Runway that might be useful for the folks on the call to hear about?
Yeah, very quickly. I mean, again, 18 months, 12 to 18 months, looking to secure financing to bridge. And going back to your current investors, realistically, it's going to be your current investors who help you get through whatever you believe the period of time is that you have to sustain. And so I'm seeing everyone going back to current investors for a bridge round. And then third is sort of structuring that round so that the way the round is done and constructed, it's not a signal for something that will hurt the company in the subsequent round when hopefully things get back to some sense of new normal. So you have to structure it very carefully. And lastly, for the investor, you clearly have more leverage than you've had in a long time. Lots of money in the world, very few good ideas, great founders. That's changed a little bit. And so I think founders need to pay attention and see that some of these rounds are closing and learn about, when times are tough, which investors are sort of abusing that leverage and which investors are really thinking longer term about how to stick behind founders and help them. You can take advantage of your leverage. It's not a bad thing. But abusing that leverage is something that is probably inappropriate. And I think it's important for founders to pay attention to that, looking in the market, because these are the times when people's sort of real values and their true self is revealed.
Two sets of comments on cost containment, and there's a lot more that can be said on fundraising. I think there's a lot of questions on fundraising, so I'll save my fundraising thoughts for later. On cost containment, there are a set. I always have this image of those fire extinguishers that says break in the case of fire. There are a certain set of actions that you only take in the case of fire. And guys, we are surrounded by fire. So there are a number of unorthodox moves that are in the table that wouldn't normally be. So I've seen some of our companies go to suppliers and say, I need 120 days. I'm not paying anything for 120 days, and I need you to continue to supply me. Otherwise, I will not make it to the other side. And lo and behold, most of them accept. Royalty payments, no royalty payments, frozen. Not only frozen, I want a 6 months free holiday on the royalty payments. Why would I give it to you? Because I need it for survival. And that's how I keep myself from cutting into the bone. Creditors, I've had not only covenant holidays. I want to go to pay in kind interest for 12 months. I cannot pay you. I need you to covenant holiday and 12 months instead of interest payment. Doing PIK. Going to your senior management team and saying, guys, we're going to pay you in equity for the next 12 months. Everyone needs to pitch in, and we'll provide some incentives so that's a good thing. But it's a time to pass the hat, and all of us need to contribute. So these are certain tools you don't normally do, but now is not a normal time.
Understood. Yeah, I think we've had a lot of conversations with Endeavor entrepreneurs about, is it that moment, to use your metaphor, Martin, to break the glass, right, in case of fire? And I think it's very useful for folks to hear these perspectives.
Well, one last thing just to add to that is there's something really enduring that comes out of the exercise that Nicholas and Martin have suggested, which is a discipline and attention to detail that sometimes hyper growth oriented startups lose sight of, because they're kind of trying lots of new products, they're doing lots of things, they're building for growth. The kind of discipline, executional discipline and attention to detail, that muscle that you develop by looking at every line item and really managing the business in totality, it's a great muscle to develop, as a silver lining, if you will, and you'll take that with you even beyond these times.
I do want to address a couple different fundraising scenarios, and I'll try to run through them quickly. But let's start with the ones we have a number of entrepreneurs. Obviously we've invested in with Endeavor Catalyst, who do have very good and supportive investors behind them. And so, guys, I think you've alluded to this idea that the best place to go right now, if you need to shore up your balance sheet, is to do an internal round, right? Is to go back and talk to your current investors about structuring something. So I wanted to drill down on that and just say, how do you recommend founders approach that conversation? How do you structure those, right? Should they be convertible notes to the future? Should they be kind of flat to the last round? What's your advice? Again, understanding situations are different, but how should entrepreneurs approach that conversation with their current investors, assuming they have those types of investors on board?
What I can say, even when you first invest in a company, I think the VC industry is so different from other industries, because you're going to partner for a decade or so. So you always want to close a transaction that is fair and that both parties are happy with. And this is in normal times. Now, in abnormal times, if you would approach a conversation like that, you would also try to do the same. Come up with something that is fair, that the team feels comfortable, that they are being treated well, but of course, under the circumstances that this is a very rough environment. But it's in the best interest of both entrepreneurs and the investors that something is closed, that everybody feels a good sense in the stomach about. So you can have whatever instrument you want to agree to. Convertibles are very easy because you don't have to define a valuation now, and maybe you do a convertible with a cap at the last round valuation, or you have some discount, or you put some incentives there for the investors to be comfortable with the instrument. You can do a new price round at the valuation of the last round. It also depends very much on what is the size that is needed. Is it a very significant check? And then it's hard even for the investors maybe to validate something like that. Is it more of a bridge that the investors can digest within their funds and they can produce the support? But at the end of the day, I think everybody is aligned in trying to do something that is good for everybody for the long term, and convertibles or price rounds, case by case.
And Martin or Shailesh, one other element of the question, when should entrepreneurs do this, right? When should they be pursuing these conversations with their current investors?
I can go first. I was in my 25th reunion from business school just last summer, and I went to a class on family wealth transfer. And the statistic that scared me was that only 5% of families are able to remain wealthy into the third generation. So 95% of families fail in that transition. And then when you look at why they fail, it's not about business disruption, economic cycle, over lever. The number one driver of wealth destruction was a fall down of trust among the family members that led to wealth destruction. When I look at the companies that I've been involved with that have ended up in bankruptcy, in almost all of them, you have a fall down of trust and a collapse of the relationship between entrepreneurs and different investors. More important than structure, and Nico is right on about all these structures that allow you to pun the valuation discussion, it's around making sure you're doubling down with a group of investors that have the same values, that you like, that you trust, and that you don't bring in dysfunctionality into your cap table. When you have different people with different horizons, different experiences, too many different experiences, and different structures. Someone has downside protected. Someone came in at a very high valuation, so they want to swing from the fences. Someone is an early stage investor, has never seen liquidity. Their risk profiles are so different that driving consensus is really hard. So I think who you get money from trumps the structure and the valuation at which you get it from. And I think over communicate and raise money when you need it.
Yeah, and I would add to that, I agree with all the comments that start sooner than later, because these conversations are taking much longer now, even with existing investors. Don't try to time the beginning of a fundraising process. Anyway, these are conversations where you're building trust, you're building a relationship, and if it's your existing investors, you're really getting alignment on a shared perspective on how the world's going to change and how your business will change accordingly. So even if it is an existing investor, there has to be an alignment on a very new reality and a new future, and that takes time. I'd say in terms of like very tactical, but one thing that I've seen, I'm pretty active angel investor. Let me speak to that for a lot of the earlier stage founders. What I've seen across the stronger subset of my portfolio is that a lot of founders are pursuing converts with no cap, but a decent discount. And what that allows is, it allows signaling to the market that you're not going to have yet another round of investors or the current investors sort of getting a beneficial valuation. It makes it easier to set the valuation in the subsequent round when things stabilize, somewhat. But for the current investors, they still get a decent discount, acknowledgement of the fact that they're bridging when they might not have otherwise expected to do so. Not everyone can pull that off. The basic assumption behind that is the business has to be strong and viable, and everyone has to believe in it. But that's something I'm seeing across literally 4 or 5 businesses in the last week and a half, 2 weeks. I've been talking to them about that they want to structure it that way.
Alan, we have a lot of questions coming in from entrepreneurs. I just want to make sure we get to them. And just on the financing side, it was interesting. There were some coming in. We had Mohammed of Clasera in Saudi Arabia and Guilherme of Dr. Consultant in Brazil asking about the fact that ed tech, health tech, some of the suddenly hot areas, and whether now might be actually a good time to fundraise, and whether valuations are going to likely go up or down in these areas, and just wanted your perspective on that. If you are in one of those businesses that actually may in fact be benefiting during this time. So does anyone want to address that?
What I can say is that for sure we are witnessing some changes in behaviors. I mentioned before, telemedicine was not even legally allowed in many of the countries where we operate, and now it has been regulated. And I cannot see someone going to the emergency room for something minor next year if you can connect through video with your doctor and get it resolved. I think there are a number of things. Everybody's taking classes now digitally, and before that was not something that people would consider. And maybe we will go back to normal, where everybody will go to school or to university, but maybe there are support classes. So there are a number of things that you really don't need to have people travel to the school, and you can take them digitally. So there are lots of new opportunities that will be emerging out of this. I think right now is very early in the game. I'm not sure that in April or May 2020, you will have flows of capital going into these sectors, because this will be the next new thing. But definitely, if I am an entrepreneur or if I have a company in that space, I will make sure that I get ready for the second half of this year or the first half of next year. I get ready, because probably you can articulate an amazingly compelling story based on what you have accomplished this year that will be very, very attractive to investors.
I agree with the twist. So we have investments in EdTech, Hotmart in Brazil, Arco in Brazil, Byju's in India, healthcare tech, Dr. Lieb in France. It is a unique, once in a generation opportunity to invest in accelerating customer adoption at 1/10 the normal cost. People will try telemedicine because they can't go to the hospital, and in probably 90 days they will be able to go to the hospital. What a horrible waste to not spend the next 90 days massively making your services massively available. The same with learning a second language. Duolingo, another portfolio company of ours, it's online classes. I mean, when you can't go to the physical class, you try this for the first time. So there is a unique opportunity to invest in customer acquisition at what's likely going to be the lowest CAC you ever see. And that is the reason to raise money. I wouldn't raise money just because you're temporarily hot, because maybe you are, maybe you're not, hard to know. I would raise money to capture this window of adoption.
Yeah, I mean, just to echo, separate operations from fundraising. Operationally, I go back to a question about marketing as well. Look, you've got Amazon, Apple, all these travel companies which were majority spenders on search advertising, social media advertising. Those CPCs have cratered on the most valuable inventory in the world. So if you've got a business like what Martin described, perhaps in a very managed way, if there's real demand, because in certain categories, demand's completely evaporated. But if there is demand, let's say people looking for telemedicine appointments, it's an interesting time to buy inventory, to pursue demand that is completely based on the fact that you've got this opportunity to leverage technology for a new way of delivering a service, education, healthcare, what have you. So operationally, I think back to 2008, 2009, it goes, different situation, different environment, advertising. But when we were at Google, we ran a campaign very aggressively called Speed Up Through a Slowdown. And it was all about moving marketing budget out of traditional media into digital media by, reaffirming ROI and talking about driving sales and how advertising on brand is a waste of money in an environment like this, but driving sales is a smart way to spend money, especially when it's cost effective. We saw a nice bump. So I've lived through that experience where you've been able to run a business with a service that can benefit, if you will, in this kind of environment. And I think finding really smart, targeted, surgical ways to go after it makes sense. Now, fundraising, and I look to Martin Nicholas to speak to this, is to keep it real. What I'm hearing from some investors is it's hard in this moment to sign a check for a new founder if they haven't physically met them, like physically spend time with them. And I think we as an investor community have to get more comfortable, ironically, with executing the business of investing entirely online and finding the signals and the cues that allow us the comfort to write those kind of checks. And candidly, I don't know that the community is there yet. Early stage will probably get there sooner than later stage, understandably so. So I think the drive to raise money will be somewhat constrained, not by the quality of the idea or the merit of the business and the opportunity and the timing, but the investment community getting comfortable executing this kind of business in this environment to closure.
Great. Alan, are there any more specific financing questions before we have a lot of other questions I want to get to from the entrepreneurs, but did you have one more finance related one?
One more quick one, because I think a couple entrepreneurs asked it and I wanted to ask it too, but it gets to Nico's comments earlier kind of about luck playing a role here, right? So some companies, closed around in February and are in a good spot. Some others were planning to go to market in March, right, or April. And, they're asking us a lot of questions around, okay, I'm not in telehealth or one of these things. I just happen to be a really good fintech company or a really good, kind of business. When will the market potentially actually be open again for new investments with outside investors, right? And we don't know, right, to Martin's comments about the scenario fan, but I wanted to get the panel's views on, what's kind of a best case scenario, what's a medium case, what's a worst case, right, on when a good entrepreneur running a good business who maybe doesn't have existing investors they can tap could actually think about being able to raise a round from outside investors.
I can speak for early stage investments, and I can speak for ourselves. I think the market is open. We are open. We have the benefit that we don't price an asset based on discounted cash flows or based on the fundamentals. At the end of the day, we invest a check for 20% of the company, and that's a negotiation. Is it for 15% or for 30%? So those are the types of negotiations. If we have conviction on the founding team and we have conviction on the space, we're totally open and available to deploying capital and doing investments. We think that the meeting in person is a very Silicon Valley thing matter, because everybody goes to Sand Hill Road and you're there and just people flow to your office. If you operate throughout Latin America, it's of course preferable, and we would love to meet with the teams. But if we can spend enough time with a team that we haven't ever met and we haven't spent enough time through video, and everything is super compelling, and we check references and they come amazing, and we need to deploy a seed investment of $2 million, we're completely open to doing that. By the way, there are many conversations that are ongoing. So they are with teams that we have conversations that started last year or started in Q1, and we have met with the founders. So it would be a continuation of that, and that is even easier. So that's speaking for ourselves. Speaking for growth, I think Martin can say more, but I think it's harder because you really need to value a company on its fundamentals. You are closer to public market types of valuation methodologies. And it's really hard if you don't know how hard the revenues will be hit, what will be happening with that business over the next couple of years. But I don't want to get into that territory. I can allow Martin or Shailesh to comment on that.
Martin, do you want to comment?
Yeah, I mean, I've been an investor for 20 years. I want to oversimplify what I do, but when it's sunny and love is in the air, I sell. And when it's rainy, I buy. It's raining really, really high, and you're on the other side of me. This is not if you can delay fundraising, you are likely going to see a better fundraising environment 18 months from now. Now, if there are massive opportunities, you're running out of cash, in both situations, you have no choice. You fundraise. I think my recommendation, unambiguously, raise from people you know really well, and as little money as possible, so that you are in a good position in 18 months.
I think that's a good summary. Linda, I know we have a lot of entrepreneur questions, so why don't we go there, and maybe we'll come back to one or two more on fundraising.
Well, first of all, I love entrepreneurs always being, the opportunity-driven optimist. They've heard all of you on 18 months of cash preservation, and yet we're still getting a bunch of questions about, yeah, but what about a percentage of cash for the risky, for the little bets, and what about M&A opportunities? If as a buyer, if the valuations are good. So can you just quickly address that? Because they understand keep all the cash in the bank, but they still want some opportunity. What would you use for growth? What would be worth now investing in as an entrepreneur?
My view doesn't change, and I appreciate the questions, but I think this is an opportunity for businesses to focus on their core business, assuming the core business is going to continue to be the engine that drives the success of the overall business. So if you're in the travel industry, there may be fundamental existential questions about the viability of your core business, but putting that to the side, this is really a time to focus in on the core business, execute well, tension well, because when you just don't know the demand curve, it's not a time to play around by diffusing your limited capital and resources across lots of different things, right? It's about minimizing risk, but also shoring up, the core business so that it can succeed in the long run. So I'm not swayed by the little bets here or there. I think, just in my experience, talking about pattern recognition is not the time to do that. Now, acquisition is a little bit different, but depending upon your cash position, the nature of your business, the rationale, so there's so many factors. But, if you can find cheap assets, a little bit like what Martina was talking about as a financial investor, but if you're operating I have a portfolio company right now, which you and I, Linda, were talking about it as a counter-cyclical business, sort of, gambling, gaming, which tends to do pretty well in crises like this, and they are doing well. And they're scouring the market opportunistically for really cheap assets that complement what they do. And they're finding a few potential opportunities, but that's a very sort of specific, particular thing. I still think the main message to me is focus on the core, shore up the core business, make sure it's airtight, and that for 18 months, you are able to execute with a very unsure demand curve so that you come out at the other end with optionality and the ability to pick up and think about growth at that time.
Let me take a crack at two exceptions to our unambiguous recommendation to hunker down. This is a unique opportunity to get very close to your customers. And I'll give an example. Arco is an online learning platform. And when the schools are closed, all their tools were made available to the customers, but the customers were grossly unprepared to go 100% online. The teachers are not trained. It's 1 million students. There's too much variety. Over the course of 2 weeks, Arco created a virtual school, getting the best first graders, the best second grade teachers, the best third grade teachers, and created YouTube channels where they run the first grade, the second grade, and the fourth grade using the platform, and created this available to all the students. And you've got 1 million kids and 200,000 schools, 20,000 schools, super grateful that Arco delivered in 2 weeks and created a new platform. They are going to emerge from this crisis with a level of customer loyalty unrivaled. So that's an example of using the crisis to get closer to the customer. I'll use another example of another opportunity. I want to share my screen and show a picture of a Endeavor company that used this crisis to do a transformative M&A. This is the Hotmart team from Brazil in New York during the middle of the pandemic, defying all Trump's lockdown orders, to merge with the #1 player in the United States called Teachable to create what hopefully will be a global leader in online courses for independent short duration courses. And this was done, this is JP on the left, and there's Ankur from Teachable, and the rest are the other teams and it's a sign of courage, and this will be a transformative transaction, and I think Hotmart will emerge stronger from this. So awesome.
Yay, I love that. So I love this next question, which is about whether, it's from one of our entrepreneurs in Turkey. And the question is whether people are ever going to go back to shopping malls? Like, is retail dead? Is everything moving online? And I guess this is asking you to use both your crystal ball, but also data, not just for retail, but for other things. Like, what is going to be a momentary 3-month, 5-month, 1-year behavior change? And then we kind of, revert back to not normal, but to, more traditional behavior types. And what do you think is now really changed for good?
What I can say there, and of course you mentioned retail, but we can mention a bunch of different industries. We need to go back 20 years, and there has been a continuous evolution and a continuous shift from physical to digital. When Amazon started, e-commerce was 0, and now depending on the country is 5%, 10%, 15%, 20%, 25% of total retail. So that has been happening and was going to continue to happening. And 10 years from now, we would have seen a massive acceleration in that direction. 2020 is just an acceleration to a trend that was already happening. So of course, in 2021, people will be going back to shopping malls and they will be going back to theaters or whenever this is over. But every year you will see less of that relative to users leveraging digital alternatives. So I would, if I'm an entrepreneur and I'm getting something started now, I would definitely look forward and I would definitely try to focus my energy and my life and my capital and my investors' money towards things that are going to have tailwind and will be riding this wave to digital that is unstoppable and now became accelerated. And for sure, at the end of 2021, it will be further ahead than what it would have been if we didn't have COVID.
I second that. I mean, it's a little bit like a storm. It's a massive storm that accelerates the fight for survival of the fittest that was already going to happen. Shopping malls, we're going nowhere good. Department stores, we're going nowhere good. Movie theaters, we're going nowhere good. Because of this, what would have taken 10 years is going to happen in 2. But it doesn't dramatically change what we look like 5 years or 10 years from now. With some rare exceptions, I think cruise lines are being challenged in a world with more health. I think business travel is challenged in a world where we've all discovered all that travel we were doing probably didn't need to do it that much.
Even offices, who's going back? Zoom rooms are pretty good.
Or business models like, let's all be crowded in a open space with lots of young people because that's the way to work in the future. Maybe it doesn't go back that much. But broadly, I think it's just, as Nico says, it's an acceleration of a trend that was already happening.
I don't have much to add. I think that's true. This is just accelerating digital in the direction it was already headed. And for physical space utilization, I used to sit on the board of a real estate company called JLL. And so we used to talk about this quite a bit. But already what you were seeing was space was being forced to be used as one of 2 things: high utility or high experience. High utility are all the Amazon warehouses and all the back end of e-commerce and online. And high experience, you could say maybe an Apple store, obviously an amusement park, things like that. And so I think it's accelerating for the offline space utilization, the quality of the experience. And even there, we'll see how long people are comfortable before they go to Disney World or go back to an Apple store instead of buying the iPhone online. So I think it'll force that trend in offline space use towards high experience, differentiated, unique experience. And even then, how good is the experience to force people to come out and commingle is an open question.
Okay, 2 last questions before I have Alan ask a final one and then have you guys give your closing thoughts. But Martin, you spoke about this trust issue, which I love. I always say Endeavor started because there was no trust. There were entrepreneurs, even if Nico, they didn't know what the word was. There were entrepreneurs we knew in emerging markets around the world. There were investors, there were people with capital. There was no trust. So I so agree with that. But what happens if people actually have investors they don't have that trusting relationship with? Like, how would you advise them in this moment when I think, Shailesh, you mentioned, people's true selves are coming out, and what do you do?
Well, that's hard.
Hey,
You're in a
you
bad
really
marriage.
you gave him an easy one there, Linda.
Yeah, you expect easy questions, Martin? Come on.
Try to convince him to sell his shares to someone you trust.
There you go.
It's hard. It's hard. And in moments like these, people show their true colors. The wimpy CEOs show their wimpy. The short-term greedy investors show their colors. And you should not forget what people's true colors are, because they are true. And I think rather than try to mend a relationship that's broken, try to get out of the relationship and try to find ways in focusing your attention and your loyalties and your partnership with those that you can trust. I don't fundamentally believe people change.
Yeah. What I would add to that is, if we have in our portfolio a founder CEO that we don't trust, the first thing that we do is go back and say, where did we screw up? We made a mistake. There's something that we did here that was wrong, because we want to have 100% of the teams that we fully trust with our eyes closed. By the way, it is like that, but we want to keep it like that. And if in any scenario, any situation, it is not like that, it is because we made a mistake. And the same for founders. If you are at home and you are thinking about calling an investor and you have second thoughts because the guy is not transparent or has a hidden agenda, or you don't know exactly where the investor stands, then you made a big mistake. You invited to your home, to your company, to your life, somebody that you shouldn't have, and it was a mistake. Of course, now you're stuck, but I think you can try to mend it somehow, maybe if there's an opportunity for a secondary transaction, but sometimes it is not so easy to get something like that done. And then you will have to live with your mistake and try to navigate through your mistake in the best way that you can.
So Alan, do you have any final questions before I ask my last one?
I would jump in just to kind of acknowledge that there is a fair amount of good content being put out right now related to fundraising, right? And we've been compiling a lot of these resources and articles and podcasts, and obviously we're doing things like this. But I wanted to ask the group, do you guys have specific books or articles or things that you've been sending to entrepreneurs, particularly, and I'll address what Martin said early, maybe younger founders who've never lived through anything like this before, right? This is their first time, right? And so you guys all have experiences you can go back to from 08 or from 01. For folks who are trying to kind of self-educate as fast as they can about those times, do you have any other resources you would direct them to?
Candidly, for me, it's been mostly conversations and anecdotes and stories from the past, from the two experiences that somewhat, like this global systemic crisis, and connecting them to others who've lived through it as founders as well. And what you tend to see is the more you can increase the velocity of sharing stories from founders who've lived through it, is probably better than a book. And so leveraging our collective sort of networks and our connections and sharing them and making those connections happen so the stories can be told and you can triangulate on the truth for you as a founder is, to me, probably the most important thing you can do.
Fair enough. Well, Linda, I'll turn it back to you.
No, sorry. What I would say is go to the Endeavor directory and see who is there that you want to talk to, and call Alan and ask for an intro. We have a network of people. You use the network, leverage the network. And if there's someone that is not within the network and everybody's going to be 2 degrees of separation or 3 degrees of separation, talk. I totally agree. You have to talk with people that have fundraised at the end of last year, that have raised in Q1 of this year, that are peers in other regions, that have had some successes with certain investors, figure out who's active in the market. So you need to do a lot of research, and I think it's not a book, it's open source.
So we have, very quickly, we have a portal for our portfolio companies that has tactical tools and videos and stuff, and all that's good, but then Endeavor has webinars like this. What you really need is an old mentor. And by old, I mean over 40, because we're all entrepreneurs, and all of us in this call are.
That's too old. I think by then they are obsolete.
I think you
39.
You want one person that you can rely on through this next 6 months that you can call frequently. Sometimes to cry, sometimes to celebrate, sometimes to show fear. Find your anchor in someone who's been through this before and invest in that relationship.
I love that. I will just add, although I'm worried that it's just like the lack of hair color. Now my gray hairs, and that's why you're saying we're all old. I will add that the Endeavor Entrepreneur Resource Center, we're putting up, our team is curating the best of these online resources and offline resources weekly. We have these webinars that are weekly. The next ones coming up are, Nico, your former co-founder, Marcos Galperin, the CEO of Mercado Libre, Kevin Ryan, a serial entrepreneur, and Jason Green, the top SaaS investor and founding Endeavor board member, along with Bill Salmon, who was for decades the guru of entrepreneurial finance at Harvard Business School. So we're very excited about these. Our teams are also, to Shailesh's point, organizing peer-to-peer groups. And we have our Outliers event coming up in June, different verticals meeting. So I encourage you, there's nothing better, actually a shoulder to cry on, to have people going through this at the same time. So Endeavor is here for you. And the last thing I'd love you each to touch on, Shailesh, we'll start with you, then Nico, then end with Martine, is I'd love you to answer closing thoughts, two things. One is something that brings you hope, right? I think that it's always nice to end on the optimistic side. And then finally, one last piece of advice. If you could give founders one gem, what would it be?
Well, I'd say on the first one, I'm an optimistic person by nature, but I think I'm optimistic now, being categorized as old based on facts and life experience. As many of us have said, we've been through the tech bubble. We've been through the great financial crisis. For others in Southeast Asia, they've been through the Southeast Asian financial crisis, or whatever the systemic shocks you may have seen or lived through, and we all came out the other end. And I think human history and recent history is a testament to persistence, adaptability, savviness, and entrepreneurship. And so my main message to everyone is stay focused, keep believing. This is a test for sure, and it's unlike any other, but it's a test, and there will be an end. It will end, and we will come back to some sense of a normal life with maybe a few wrinkles, but it will end. And so I remain hopeful because I've seen that story play out, and we continue on. And so because everyone, I'm sure, is building with the long-term in mind, you just can't over-index on what's going on right now. You have to manage it appropriately, but not to the detriment of the long-term viability of your team, your business, and your mission. The one piece of advice I would just say, if anything, is empathy. Spend time with your team. There's so many people who are going through human emotional things. People who are curling up on the couch, who can't bring themselves to dial into a Zoom call, or they're feeling overwhelmed by the combination of work and home and children and parents they're trying to take care of. And so I think the important thing, while we've mostly focused on the call about the viability, sustenance, growth of our businesses, is that all of it only works if we bring our full human selves to work and we allow others to bring their full human self to work. And a lot of times that's not very happy, but as leaders, we have to have the emotional depth and capacity to take on whatever is going on in our team's lives and be a shoulder they can cry on or speak to without judgment. And so I'd say empathy to me is sort of the last kind of thing that we haven't addressed, but means lots of one-on-ones, being available. And I just had a call with the head of sales we just hired out of Facebook into a startup, and literally transitioned from a really stable job to an early Series A company. And I think the thing he told me on email he most appreciated, because we were talking about sales strategy at the end, was when I said, I understand as a human being, this is a jarring and really unsettling transition you've gone through. And I just want to acknowledge that. And I want to say, if you ever want to talk, just reach out, and happy to talk unrelated to the business. And that really calmed him down at a human level, which benefited the business.
Nico?
Yeah, so I'm first generation Argentine. Both my parents are immigrants. They came from really tough stories, and they created a good life for themselves and for their families. We've been through many economic crises at work, and same as with everything else, this will pass. So that brings me hope. It will pass. It's a quarter, a couple of quarters. Before I use the word patience, maybe we have to use the word being strategic and really ensuring that you do what you have to do in the short term. But this will pass. What also brings me hope is, it was mentioned in the call, but everyone in the ecosystem is going out of their way to support and help and do anything that they can. And many of the startups, we were discussing Runway and cash balances. So it is not their obligation to donate pesos or dollars or reais, but every company that we see in the edtech space, they're providing free services to communities. In the health tech space, they're providing their telemedicine infrastructures. E-commerce companies are helping small stores go online for free. And there's so hospitality companies are providing their rooms for doctors and nurses to stay there for free. So everybody is doing something, and it is amazing to see that, even in the context of, then they go and they look at the numbers in the company and they are concerned about Runway, but still they have part of their brain and their heart that is out there to help. And then, just as a final reflection, I think that probably the core of this conversation was trying to convey once again that we need to be realists. Optimism sometimes is not the right attitude when there's an earthquake. When there's an earthquake, you need to fight for survival. But then the earthquake is over, and there is a light at the end of the tunnel. And we don't know if it's 6 months or 12 months or how long it's going to take. But it's going to be a world with infinite opportunities. So super excited about being a tech investor in Latin America now and in 2021 and onwards. I think the next decade will be amazing for all of us, but we need to make sure that we get there.
I couldn't agree more with what's been said. Both Shailesh and Nicolas have said the concept that this too shall pass. What's interesting is after it's passed, we will have emerged from a near-death experience. And not near-death like the dot-com bubble that the company could have died. We could have died. This is a healthcare emergency where no matter what your age or your health status is, there is a statistical possibility that we will not make it. And when we make it, there is a transformative effect of having lived through a real near-death experience. I'm good friends with Rick Elias. He's a founder of Red Ventures.
Yes.
He has a TED Talk, and you know him, Linda. He has a TED Talk on how he survived the miracle on the Hudson and how it changed him. I went through my own near-death experience in the 80s. I have hemophilia, and in the 80s, 90% of the people with hemophilia died of HIV because of the transfusions we had to take. So I'm part of that 10%. And I can tell you, having survived the 80s, you come out with a no bullshit pursuit of big dreams like there's no tomorrow. And you guys are already entrepreneurs. You're going to be turbocharged by this bug of, second life. Get out of your way. I mean, we're going to pursue even bigger and bigger dreams. The one advice that is consistent with both Nicolas and Shailesh said it. We're all leaders in our industries and in our communities. We're role models. And we are all, to the extent of our possibilities, philanthropic. We all contribute in some way to our society. I believe philanthropy should be countercyclical. I believe once in a blue moon, you should do 5 to 10 years of philanthropy in a single year, because you can, and this is one such time. So I think it's a call to arms to us to be more solidarious and help our communities, because this is serious, and we will come out of it much stronger. That's it.
First of all, we are so blessed to have all of you in the network. Shailesh, you mentioned humanity, and I think what everyone has seen with all of you is that you all offer not only this incredible experience-based advice, but the humanity shines through, and that is what Endeavor is all about. And to all of the entrepreneurs, you are not in this alone. We are all in this together. And Martine, you mentioned, I didn't even know that story of you. And my husband survived osteosarcoma, where only 20% survival rate, and has said the same thing, that there's no BS anymore. Ironically, he's now 11 years cancer-free, and next week, the Council of Dads is airing on NBC. There's a 10-part TV show starting based on his experience. Proof, Nico, that the sun does rise again, and right, and as tough times as these are now, I think if we all band together and support one another, and then support our communities, to your points, and our employees and our customers, this is when we will hopefully emerge better and stronger, more resilient, and more compassionate. So thank you all. Sending love to the three of you and to everyone on this call. Mwah.
Bye. Thanks, everyone. Stay
Thank you very
safe.
much.